if you have a portfolio that has a specific target to infrastructure, you'll be forced to continue buying these assets regardless of the price. It's all about understanding the macro fundamentals and understanding the megatrends. Leases are structured in a way that rents have annual fixed increases, and you are getting this stable income return that is growing over time. At the same time, you're getting fairly good capital appreciation. These are essential services that people have been using, they are using them, and they will be using them in the future. A look at an average super fund, you would see that 20 to 25% of the total portfolio would be invested in alternative assets. Alternative asset classes have lower, in some cases, negative correlation to equities than any other asset classes. When you talk about private equity and public equity market, how some opportunities, they don't even reach equity markets. If you do want as an investor to get access to those growth opportunities, it is important to add alternatives to your overall portfolio.
Could you tell me and tell shareholders a little bit about your own background and your philosophy for investing?
I am a strong believer in more of a holistic approach when it comes to investing in alternative asset classes. So what I mean by this is that rather than building a portfolio that has very specified sleeves, like real estate, infrastructure, agriculture, timber, etc., and very specific allocation targets, I like to think about alternative assets portfolio as a very flexible portfolio. Yes, you do need to have a strategy, you do need to have long-term targets, but because the market is changing and the opportunity set is changing, valuations are changing, you do need to be very flexible and assess the relative value of different sub-asset classes within alternatives. So, for example, 3-4 years ago, more traditional infrastructure looked really expensive. We saw some transactions, in particular in sectors like airports and ports, are happening at the highest historical levels in terms of the equity multiples. Where do you allocate your capital during this time? So if you have a portfolio that has a specific target to infrastructure, you'll be forced to continue buying these assets regardless of the price. But if you have more flexibility within the portfolio construction, then you can look at other sectors. Let's look at real estate, let's look at private debt, at private equity, and see where I can find more attractive opportunities in terms of the entry price. And that's how I think about this. It's important to have this bigger picture, understand the driving fundamentals across sub-asset classes, understand the megatrends that are driving those asset classes.
You've talked about a few different asset classes that sit within alternatives. I think for people that are getting exposure for the first time, could you just talk through the sorts of asset classes that you'll be looking to invest in?
Just let's take a step back and think about alternative assets. It's a very broad universe, very broad term as well, used differently by many investors. Alternative assets are tangible assets. Most of them are tangible assets that have substance, and this substance has value. Asset classes that have very specific investment characteristics that define them from other asset classes, like inflation hedge, very strong income return potential, capital appreciation potential, very strong diversification benefits, but also something that gives you access to unique trends in terms of the macroeconomic shifts. The way we see it, alternative assets include asset classes like real estate, infrastructure, private equity, venture capital, asset classes like debt, private debt, real estate debt, and real assets. Real assets, we talk about agriculture, water rights, timber, etc. So very broad universe, and within the current portfolio we already have exposure to private equity, venture capital, real assets, and a little bit of real estate in the portfolio as well. Going forward, we will be looking at expanding it into new asset classes like private debt. And when I think about private debt, this has been an asset class over the last few years that has attracted a lot of attention from investors, because banks, not only in Australia but also globally, they are under a lot of regulatory pressures. And they are stepping back more and more in terms of providing lending opportunities to businesses. So we do see more private lenders coming in, both on the business side, like small, medium-sized enterprises, but also on the real estate side.
In terms of the framework that you use for identifying opportunities, I think you talk about trying to identify megatrends or super trends. Could you just talk to me a little bit more about that framework? You sort of talked about infrastructure. Yeah. Explain that process that you use for finding opportunities.
Investment process for us is a mix of this top-down approach and bottom-up. Very common phrase, you know, when you talk to equity investors, they would use very similar term. In terms of the top-down, it's all about understanding the macro fundamentals and understanding the megatrends. Now, I use this word a lot, megatrends.
It's popular.
It's popular. It's you know, it sounds very exciting, and it is exciting. But basically, these are the major macro shifts that have very strong tailwinds. So, in our current environment, those megatrends would be aging population, increasing demand for food on the back of the growing global population. It will be trends like digitalisation of our economy, of our society, innovation. It will be trends like climate change. I think aging population is something that concerns many economies and many governments. So we start seeing more and more this trend translating into investment strategies. Probably real estate might be a good example. Like if we think about real estate in Australia, again, traditionally you would think about asset sectors like office, retail, logistics, industrial, etc. Now, there are other sectors that are less traditional, and they have those, they are supported by those strong tailwinds. And one of these sectors is healthcare real estate. Now, I'm not talking about buying a hospital and operating this hospital. This is something different. This is more of an infrastructure strategy. I'm talking about an asset itself, actual property. While office, retail, and logistics, they are going through major structural changes, in particular on the back of COVID-19. It really is changing the universe. It's changing how investors are seeing those sectors. It's changing the income and capital appreciation profile. It changes the risk profile. Sector like healthcare real estate continues to thrive even through this economic downturn that we're experiencing. Why is it happening? Because these are essential services that people have been using, they are using them, and they will be using them in the future. We have aging population in Australia. I can give you some statistics. In 2013, we had I think it was a data published by Australian Bureau of Statistics. We had a population of about 14% of the total population aged 65 years and over. They project that by 2050, this will reach 21% of the total population. This puts a lot of pressure on the healthcare system. This puts a lot of pressure on the governments, so there is a lot of support to healthcare service providers to improve their services, to expand their services. Where do they do this? They do this in hospitals. And hospitals, they are property assets. So a strategy here is really to go and find those assets or develop them and then lease them to an operator. Operators like Ramsey, Healthy, etc., like large name, like good brands. Or you go, like you have young kids, I'm sure you take them during the spring season to see the GP. Yeah. Where do you go? You go to a medical center. Again, this is a property asset. Or you need to do a blood test, you go to a lab. This is a property asset. So the strategy here is really to go and build a portfolio of those property assets, lease them to operators. The attraction here is that those leases are very long-term leases. We are talking about 10 to 15 years leases. Leases are structured in a way that rents have annual fixed increases, and you are getting this stable income return that is growing over time. At the same time, you're getting fairly good capital appreciation because there is restricted supply on these assets. So this puts healthcare real estate as a very attractive asset class versus some more traditional sectors within real estate. And we have strong relationship with one investment team in Australia that is now implementing the strategy and building the portfolio.
I was wondering if you could explain to people the role that alternative assets plays within a broader portfolio. And I think for a lot of investors, it's accessing these opportunities hasn't been so easy in the past. So I guess maybe just talk about why people might not have had exposure to alternatives before.
Alternative asset classes, they do form a very big part of an investment portfolio. So, you mentioned institutional investors. Look at an average super fund, you would see that 20 to 25% of the total portfolio would be invested in alternative assets. So it's a very important asset class for institutional investors, and I would add for any investor, because it provides very strong diversification benefits. Alternative asset classes have lower, in some cases, negative correlation to equities than any other asset classes. It also gives or has some certain investment characteristics that are not easily accessible in other asset classes. For example, in inflation hedge, when we talk about infrastructure, real estate, some other asset classes, they all would be serving very strong inflation hedge. They have very strong income return component, not all of them, and we can talk about this later. Like, for example, private equity strategy would be predominantly focusing on capital growth and capital appreciation. Real estate and infrastructure, agriculture, water rights, they would be predominantly delivering income return over time. And these are the asset classes where you can access these themes and trends that we talked about. And often those themes, they are not accessible in equity markets. So I really like examples when you talk about private equity and public equity market, how some opportunities, they don't even reach equity markets. Like, for example, Facebook or Uber, initially, they were venture capital investments. Same with Spotify, this application that you use on your iPhone for music. It actually never really went through IPO because it was so successful raising capital from private investors. So if you do want, as an investor, to get access to those growth opportunities, it is important to add alternatives to your overall portfolio. You did ask this question, why historically it hasn't been easy to access this asset class. There are several reasons for this. One is that it's an asset class where you need to have scale when you go and build a portfolio. By scale, I mean, if you look at an institutional quality offering, the minimum ticket size would usually start from 5 to 10 million. So you do need to have scale to build the diversified portfolio. You do need to have very strong network, very strong relationships with the investment teams in order to access it, because the capacity is limited.
And so you've named a broad universe of investment opportunities. As we sit here today, where are you seeing value?
Value. Where do I see opportunity? That's the question for me. Very exciting time, because so many things are changing now in the economies, globally, not only in Australia, in our society. And really the opportunities I'm focusing on are the ones that have or are supported by strong tailwinds. Factors like aging population, increasing demand for food on the back of the growing global population, digitalisation of our economy, of our society, innovation. I think these are all the trends I'm focusing on, and then within each of those trends, I would select strategies that are implementable in alternative asset classes.
And you've been with Wilson Asset Management a relatively short time. How's that experience been?
It's been excellent, absolutely fantastic. I am very excited to work alongside people like Jeff Wilson and Kate and the rest of the team. I think it's the team that has such a strong integrity, and when I observe the interaction between the investment team and shareholders, I can see that there is strong and deep trust. The relationships also have been spanning over many years, and the shareholders are very loyal to Wilson Asset Management. But also what I really like, and it's in line with my beliefs, because when I manage capital on someone's behalf, I have fiduciary duty to advocate on behalf of my investors, on behalf of my shareholders. And this is what Wilson Asset Management is excellent about. They are advocating on behalf of the shareholders. They are prepared to fight through for any regulatory changes that might not be beneficial for the investors or for shareholders. They are innovative in the way the investment strategies are structured or the investment offerings are structured. And they are thinking forward. You know, the example that we now have WMA as part of our business, it's an example of forward thinking. It's an example of vision, because alternative asset classes has a very strong future.
A final message on a personal note, an opportunity to say something to Wilson Asset Management investors. What would you like to say to them at a personal level?
At a personal level, well, I would like to say that I am truly passionate about this asset class. I really believe it can make a significant difference to the investment outcome of the overall investment portfolio. And I am excited to be working together with Wilson Asset Management team, because their way of operating, their way of working with shareholders is very much in line with my personal beliefs as well. And so I am looking forward to working together with the shareholders, advocating on their behalf and delivering the financial outcomes that will support their financial well-being over long term.
Great. Well, listen, it was lovely to meet you today. Thank you very much for hosting us.
Thank you, James.
And best of luck in your new role.